The economy, it could be moving towards recession. Is there a view right now among financial professionals that that is something that you have to prepare for from an investing standpoint?
Well, I don't think a lot of people are looking at this year, the economy taking a sudden U-turn into recession. But in terms of what investors should do, hopefully they were balanced ahead of what you saw last week with the 800-point drop, but more importantly, with that huge drop in rates. The whole key to diversification and investing is to invest in duration before the stock declines hit, or because then the interest rates decline when there's a fear of an economic slowdown. And that's when you make your money on that non-stock portion of your investment portfolio. When the interest rates drop because of recession fears, then the longer bond yields drop the rate, and that increases prices to investors. So we saw a lot of what a recession fear can do already in the bond market, and now investors are at a tough spot. Interest rates are so low, they're near their cyclical lows, and stocks are teetering near their highs. Where do they allocate? It's really a difficult time for investors to see through all this noise, and that's why they have to remain not emotional and not headline driven.
All right, let's assume we're not emotional and not headline driven. You mentioned the tough environment right now with the yields at the lows that they're at and the stocks near record highs. What exactly do you then buy to position for the next 6 to 9 months?
Well, let's look at some sectors. The financial sector, for example. You would have thought that when the 10-year was at 3 1/4, the banks would have run up, because traditional thinking is higher rates help banks because they can reprice loans quicker than deposits. But on this cycle, we did not see that, and we saw bank stocks still struggle, which is really odd. During a strong economy, we have very, very low loan losses. We have markets at all-time high for high asset management fees. There's a lot of capital markets activity. There's a low credit losses. That is a recipe for huge success for financials in most environments, and yet they've been struggling. And one of the reasons is not only just this fear of recession and European slower growth, but it's also what happens to deposits here. In the old days, deposits did not reprice as quickly, and banks were able to get that spread. That's gone. With online banking and fierce competition in an overbanked world, deposit rates have gone up, margin pressure is compressed, loan pricing is fierce. And if you look at net interest margins for banks, still the core business, you will not see much change in that over the past few years. In fact, it's declining. And that underscores one of the reasons why financials are weak and why we would stay away, especially as rates continue to drop. Banks have less opportunity. Look, we've had huge IPOs. We've had great asset management fees to these banks, and we have low credit losses. How much better can it get than it's been? And yet bank stocks have lagged.